Welcome to the Nifty Noon Podcast. If you told a Wall Street bank executive, like 5 years ago, that their firm would soon be hardwiring its internal infrastructure directly into decentralized crypto exchanges, they probably would have laughed you right out of the boardroom.
Oh, 100%. You wouldn't have even made it past the lobby.
Right. But looking at the updates we sourced directly from our newsletter over the last 120 hours, that exact scenario just became an irreversible reality.
Yeah, it's a massive pivot in market structure. We aren't talking about speculative hype cycles anymore, We are talking about the permanent installation of global financial plumbing.
Which is exactly why you are tuning into this custom deep dive today. We are decoding the daily updates from Monday, May 11th through Friday, May 15th, 2026.
The whole week.
Yeah, the whole week. And this isn't just a recap of headlines. It's an extraction of the underlying mechanics driving the market right now. And it's tailored specifically for your interests in that intersection of crypto, tech, and macro finance.
Yeah, and if we look at the slate of intelligence we gathered this week, the TLDR is just blindingly clear. This was the week we saw the aggressive structural merging of TradFi giants with decentralized protocols.
Right, they aren't just dipping their toes anymore.
No, not at all. Wall Street and big tech are no longer just buying tokens. They are physically routing their operational backends into Web3.
It's wild.
Yeah.
And to really show you how this institutional concrete is being poured, we're going to trace the causality of these events. We're not just listing what happened Monday through Friday, we're examining how the tech from one day unlocked the liquidity of the next.
The cause and effect across these 5 days is undeniable once you look under the hood. It's like watching dominoes fall.
Right. Let's start at the bedrock layer. Okay. Monday, May 11th, digital asset holdings raised a staggering $300 million in a round, led by A16's crypto.
That is a massive check.
Huge. And that capital injection valued the creator of the Canton Network at $2 billion.
Right. A $2 billion valuation for fundamental enterprise-grade infrastructure. It's a massive number, but it reflects a very specific bottleneck in the current market.
Which is what, exactly?
Well, TradFi whales. The trillion-dollar asset managers, the legacy clearinghouses, they've been waiting to move real-world assets on-chain for years.
Because they want the efficiency.
Exactly. They want the efficiency of tokenized equities, bonds, real estate, but they cannot legally or practically execute those trades on a fully public chain like Ethereum or Solana.
Okay, let's unpack this. Because understanding why they can't use public chains is crucial here. Blockchains, by their very nature, require broad consensus, right? Which traditionally means all nodes see the transaction data.
Right, it's a public ledger.
Yeah. So if a major bank is executing a complex proprietary trading strategy, they can't just broadcast that metadata to the entire world.
No, they'd be front-run into oblivion.
Totally. And they'd violate like a dozen privacy regulations simultaneously.
Precisely. They need a system that speaks the language of decentralized finance, but maintains strict data silos. And that is the specialized infrastructure Canton provides.
Which is why they got that $2 billion valuation.
Right. It connects disparate financial institutions, allowing their private subnetworks to interoperate while maintaining absolute control over who sees what data.
Think of it this way, actually. I was thinking about this earlier. Think of that $300 million raise, like laying down high-speed fiber optic cables right before the dot-com boom.
Oh, that's a great analogy.
Yeah, it's invisible to the average person, right? The Canton Network acts less like a public bulletin board where everyone can see Wall Street's trades, and more like a series of private, soundproof conference rooms connected by a highly secure, verifiable hallway. The banks can negotiate and settle privately inside those rooms, but the blockchain still cryptographically verifies that the hallway itself is secure and that the ledgers balance.
Yeah, and if we connect this to the bigger picture, when A16's leads a $300 million round here, they are betting that Canton's architecture is going to serve as the central nervous system connecting the legacy financial world to Web3.
The plumbing.
Exactly. It solves the technical paradox of wanting decentralized efficiency without sacrificing centralized privacy.
But, compliant pipes are completely useless if they are empty.
Right, you need something flowing through them.
Exactly. Wall Street isn't going to move institutional liquidity on-chain if the currency layer traveling through those pipes is volatile or constrained by network congestion. They need industrial-grade financial freight. Which brings us perfectly to the massive power play we saw the very next day.
Right, Tuesday's update on Circle.
Yeah. On Tuesday, May 12th, our newsletter reported that Circle raised $222 million for its ARC L1 token presale.
Another massive raise.
Right, and this happened alongside them posting incredibly strong Q1 earnings and seeing massive growth in the supply of USDC.
This is where we see the asset layer catching up to the infrastructure layer from Monday. Circle is supercharging their execution environment.
I have to push back hard on this strategy, though.
Oh, really? Why?
Well, building a new Layer 1 blockchain is notoriously expensive. It's incredibly difficult to secure, and the market is already fiercely saturated. If USDC is already experiencing massive supply growth, and Circle is printing money just acting as a digital dollar issuer, why take on the headache of an L1?
It's a fair question.
Right. Aren't they just a stablecoin issuer risking their core monopoly by trying to fight Ethereum and Solana on their own turf?
It looks like an unnecessary risk on the surface, I'll give you that. But mechanically, it's highly strategic evolution. Circle is looking at the value chain and realizing they are bleeding capital to external networks.
How so?
Well, right now, when USDC moves across Ethereum, the validators of Ethereum capture the gas fees. Circle is providing the dominant product, but the underlying network is capturing the execution revenue.
Ah, okay. So this is about value capture at the sequencer level.
Exactly. By building the ARC L1, Circle is ensuring they have a native, optimized execution environment. They are shifting from just issuing the asset to controlling the monetary policy of the network routing that asset.
That is a massive shift.
It is. They want an application-specific chain tailored for institutional-scale stablecoin movements where they can potentially subsidize transaction fees using the yield they earn from the T-bills backing USDC.
Oh, wow. So they can effectively starve out competitor networks by making USDC transfers functionally free on their own chain.
Yes.
It's vertical integration. It's like Apple didn't just want to design the software. They eventually realized they needed to manufacture the M-series chips to control the entire hardware ecosystem and maximize margins.
That's exactly it. Circle is doing the exact same thing for decentralized money.
Right, and that $222 million war chest from the presale ensures they have the upfront capital to incentivize developers to build natively on ARC.
Yeah, they aren't just settling for being a toll booth on the bridge between TradFi and Web3. They are physically acquiring the bridge.
Which sets up a fascinating dynamic for Wednesday, May 13th.
Wednesday was a big one.
It was. Because once you have Canton building the compliant networks on Monday and Circle building the optimized currency rails on Tuesday, Wall Street needs a way to actually capture the trading volume happening in the decentralized world.
The 21 shares ETF launch.
Yes. Our newsletter noted that 21 Shares officially launched the first U.S. exchange-traded products, ETFs, for Hyperliquid.
Meaning mainstream brokerages now have direct exposure to the dominant decentralized exchange.
Exactly. But wait, an ETF for a decentralized exchange? Isn't that an oxymoron?
Huh. Yeah, it kind of is.
I mean, decentralized finance was literally engineered to destroy the middlemen. And Wall Street's pragmatic response is simply to charge a 1% management fee to package the destruction of middlemen into an IRA. It feels like Wall Street is taking the most rebellious part of crypto DeFi and wrapping it up in a neat, heavily regulated TradFi package.
From a purist perspective, it is absolutely a contradiction. You're not wrong. But what's fascinating here is how this mechanically bridges two entirely different financial paradigms.
How does that actually work in practice?
Well, look at the market mechanics and the custody rules dictating trillions of dollars in global wealth. Hyperliquid has a massive, thriving trading engine, and the HYPE ecosystem is generating real revenue. But a registered investment advisor, an RIA managing a pension fund or a family office, they cannot legally or operationally allocate client funds to a smart contract.
Right, because of the custody hurdle. They can't manage the private keys or seed phrases for their clients.
Exactly. They can't secure institutional capital with a hardware wallet sitting in a desk drawer. They require qualified custodians. So what 21 Shares is doing mechanically is physically acquiring the HYPE tokens, locking them with an institutional custodian, and then issuing traditional SEC-compliant shares against that reserve.
So they are abstracting away all the operational friction.
100%.
You don't need to navigate bridging protocols. You don't need to worry about gas optimization or smart contract risk. You just log into your standard brokerage terminal, type in a ticker symbol, and you own a piece of the decentralized future.
It allows the legacy wealth management world to harvest the financial upside of DeFi without ever actually leaving the regulatory safety of the centralized present.
Wow. And once that precedent of wrapping DeFi for brokerages is established, it leads directly into the sheer scale of those brokerages opening up their core plumbing. Which brings us to Thursday, May 14th.
The Charles Schwab rollout.
Yeah. Traditional finance titan Charles Schwab officially launched spot Bitcoin and Ethereum trading for select retail clients natively on its platform.
So the pipeline we've been tracking all week is now fully operational at the retail layer.
Here's where it gets really interesting. We have to talk about the behavioral finance aspect here and the sheer scale of the liquidity we are dealing with. Schwab is not a crypto-native startup.
No, not at all.
We are talking about generations of wealth, retirees, and deeply conservative dividend investors. The amount of assets under management within Schwab absolutely dwarfs the native crypto exchanges.
Oh, easily. Let me ask you, what stands out to why when a historically conservative firm like Schwab flips the switch?
To me, it fundamentally changes the mental accounting for the average investor. When a user logs into their Schwab app and sees spot Bitcoin sitting right next to Apple stock, a municipal bond fund, and their target date retirement account, the asset is instantly legitimized.
Yes.
It removes the psychological barrier of crypto feeling like an offshore casino.
It really does. And it also highlights a profound inversion in institutional risk assessment. For the last decade, the reputational and regulatory risk for a firm like Schwab to offer native crypto execution was simply too high.
I wouldn't touch it.
Exactly. But the market structure has evolved so rapidly, especially with ETF approvals and stablecoin proliferation, that the math has inverted.
So the business risk of losing clients to competitors who offer full-suite crypto services now outweighs the perceived risk of touching the asset class.
Precisely. They have to offer it to defend their assets under management. And mechanically, Schwab isn't spinning up their own node infrastructure to do this. They are routing these trades through massive institutional liquidity providers on the back end.
Making it seamless.
Seamless. It integrates the legacy brokerage interface with crypto market-making infrastructure.
It normalizes the asset class on a scale that native Web3 platforms simply could not achieve on their own. Which brings us to the culmination of the week, Friday, May 15th. The biggest centralized on-ramp officially merging with the biggest decentralized trading venue.
The Coinbase and Hyperliquid alliance.
Yes. Our newsletter closed out the week with a massive structural update. Coinbase has become the official USDC treasury deployer for Hyperliquid, and as a direct result, Hyperliquid is permanently sunsetting its native decentralized stablecoin, USDH, to make room for deeper liquidity.
It ties every single mechanical thread of the week into a unified system.
So what does this all mean? We are watching a crypto-native experimental piece of infrastructure, the USDH stablecoin, literally being killed off to welcome in a proven, regulated, TradFi-backed juggernaut in USDC.
Managed by a publicly traded centralized exchange, no less.
Exactly.
This raises an important question regarding the mechanics of liquidity at scale. Hyperliquid realized they had hit a ceiling. If they want to process the kind of volume that the 21 shares ETFs from Wednesday and the massive retail inflows from Thursday will eventually route their way, they cannot rely on fragmented, user-provided liquidity pools.
Because decentralized liquidity is often mercenary, right? It moves to wherever the yield is highest, which causes slippage for institutional traders.
Exactly. Large-scale order books require deep, persistent institutional-grade market making. By designating Coinbase as the official USDC treasury deployer, Hyperliquid isn't just accepting tokens, they are integrating programmatically.
Like hardwiring it.
Yes. Coinbase manages the fiat-backed reserves and uses sophisticated APIs to pipe massive bands of stable liquidity directly into Hyperliquid's decentralized smart contracts.
It's a permanent blurring of CeFi and DeFi. I mean, the pure decentralization maximalists are probably mourning the death of the native USDH stablecoin. But the market is ruthlessly pragmatic. Traders demand tight spreads and deep order books.
They want the transparency, self-custody, and execution speed of a decentralized exchange, but they demand the deep pockets and regulatory stability of a centralized entity to backstop the trades.
It's a hybrid model.
It is. The front-end execution remains decentralized, but the back-end treasury management is handled by a regulated giant.
And that encapsulates the true signal of this entire week. Let's take a step back and briefly synthesize these sources. When you filter out the noise, what truly shifted in the market between May 11th and May 15th?
Well, the noise is always the daily token price action. Who is up 5%, who is down 2% based on retail sentiment.
Right, distractions.
You have to ignore that. The true signal this week was the physical hardwiring of institutional plumbing into on-chain technology. From Canton Network solving the privacy paradox for banks on Monday, to Circle vertically integrating their currency layer, to 21 shares wrapping decentralized protocols for RIAs, Schwab onboarding mainstream wealth, and finally, Coinbase injecting institutional liquidity directly into a DX.
The infrastructure is solidifying.
Yes, completely.
So for you listening, trying to front-run the next narrative, what should you be tracking based on this week's data?
You need to watch the competitive response to the Coinbase and Hyperliquid integration. That was a massive consolidation of power. Mechanically, how do rival centralized exchanges like Kraken or Binance respond?
Right, they can't just sit still.
No, they can't. Do they attempt to forge deep integrations with competing DXs to provide liquidity? Furthermore, does Tether attempt to counter Circle's dominance by launching its own optimized network architecture? The race to become the primary back-end infrastructure for the decentralized web has officially accelerated.
It is going to be a brutal battle for liquidity supremacy.
Oh, without a doubt. It's going to be wild to watch.
As we wrap up this deep dive, I want to leave you with a final thought to mull over, something that wasn't explicitly stated in the news updates, but is the logical endpoint of the reality we just decoded.
I'm curious.
If traditional finance giants, firms like Schwab, Coinbase, and Circle successfully become the primary access points, the ETF wrappers, and the ultimate liquidity providers for these networks, does DeFi eventually just become an invisible back-end database for traditional banking?
Wow.
Like, will we even use the word crypto in 10 years, or will it all just be finance running on far more efficient plumbing?
That is the trillion-dollar question defining the next decade.
It certainly is. Thank you so much for taking this journey through the week's critical updates with us. To make sure you never miss the signal through the noise and to stay ahead of the curve as this financial convergence continues, be sure to follow Nifty Noon on X and subscribe to the Substack. We'll catch you on the next Deep Dive.